Welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I am Arjun Parsati. And today we have a very special guest with us, an expert in the trade receivables market, Arvind Rangarajan. I'll briefly introduce him to you shortly. But just before we start, the title of this podcast and the subject of this podcast is TReDS, which is Trade Receivables Discounting System. And in the recent union budget, if most of you would have followed, that there was a large amount of discussion on TReDS by the finance minister. And so TReDS is going to become is a very important part of the ecosystem and in the financial ecosystem. And Arvind is right there in the thick of it. And for investors, especially for investors, how TReDS is going to affect their fixed income portfolios in a positive way. So that's what we're going to take you through in this podcast. But just before that, just a brief on the union budget and the RBI policy today. The union budget clearly came out. It was a non-event budget. The fiscal deficit numbers were largely in line, maybe slightly lower than expectations in terms of the borrowings, etc. In the borrowing, gross borrowing was market felt it was slightly higher, so there was some reaction to the yields. But having said that, in a very normal sense, there was no great surprises. The market obviously reacted on the current sentiments. On the RBI policy today, RBI also maintained rate status quo, very largely focusing on liquidity management. Clearly, given that liquidity was from a surplus of about 2-3 lakh crores, it had come down to an average of 80,000 crores a day. And now it's back to 2 lakh crores due to RBI measures of buy sell swaps and OMO purchases, etc. So liquidity is going to be comfortable. Inflation targets are all in line with estimates. So nothing great from the policy as well from the RBI today. So I think to a very large extent, markets are in a normal state of trading, especially towards the financial year end. But coming back to the most interesting topic, and this may be something new to everyone here. TReDS. TReDS is, like I said, trade receivables discounting system. Now, clearly, I mean, what is TReDS? It's very simply put. Say there is a small and medium scale enterprises selling a good through Amazon, right? So you go and buy the product from Amazon. What Amazon does is they will verify that the quality of the goods are fine from the seller, and then they will accept an invoice from the seller, and which Amazon will normally pay it in an own cycle, which could be 30 days or 60 days or 90 days, whichever it is. Uh, but having said that, the seller wants to supply more goods through Amazon, because once he sold a good, then his inventory draws on, so he has to replenish inventory, and then but for the seller to produce that good, he needs working capital. And he can't wait for 30 days or 60 days from Amazon to get that working capital. So what he does is he goes to the TReDS market and he tells, I got this invoice from Amazon. Will you discount it for me? That is, will you give me immediate cash at a certain rate of interest? And there are a huge number of participants in the TReDS platform that will tell the seller, yes, because the credit is Amazon. I know that Amazon is a AAA global credit. And I'm very happy with the fact that Amazon has accepted the invoice and they will pay you, right? So I will give you the money immediately at a certain rate of discount. So that's the way the whole platform works. But this is just a very brief on what this whole system is. Arvind is the best person to take you through. He spent 30 years in trade financing across banks, including Standard Chartered, Barclays, and Deutsche. And he's a consultant to World Bank on trade receivables and securitization. And he runs a platform called AP Factors, which is a receivables discounting. It's a factor NBFC. The factor NBFC name is Art Fine, and he runs this platform. And he does a very, very important service to the SME and MSME industry. because a lot of them, many of them who sell goods to very very strong buyers, sometimes are just not able to get funding at the right time at the right rate of interest. And Arvind, what he does through his platform is make sure that these sellers get funding at the right time at the right rate of interest, and is playing a very important part in this whole ecosystem of trade receivable finance. There's a huge thrust in this area. The whole TReDS platform star was had a volume of 2 years back 50,000 crores on an annual. Now it's close to rupees 3 lakh crores. And what Arvind tells me is it can go up to rupees 30 lakh crores on a year. That's the idea. So I'll leave it to you, Arvind. Can you, if you can take our listeners through the whole nuances of trades and how investors can actually benefit from investing in these securitized paper. In the union budget, the finance minister said that trade receivable securitization can be an asset-backed security. So, which again lends a very strong policy and regulatory framework to the whole system. Yeah, so I leave it to you, Arvind, if you can
Thanks,
take.
Arjun. It's great to talk to you and to be part of your platform. And thanks a lot for having me on your platform. To get to the nub of the topic, the trade receivables exchanges were set up something in sometime in 2016, based on a World Bank and Reserve Bank initiative to help small and medium enterprises quickly get access to working capital finance. The crux of it was that there would be an exchange where the market would basically discount these receivables based on the quality of the buyer's credit risk. So, although the person who owns the invoice and who's getting financing is a small enterprise who may be having a turnover of 50 crores or 100 crores, and his net worth is probably only 5 crores, the receivable is due from a top company like Tata Motors or Indian Oil or HPCL. So these guys then come to the platform, they do their KYC, they sign a long term agreement, the exchange knows who they are. They then upload the invoice. This invoice is then seen on the platform, and the buyer, which is Tata Motors or Indian Oil or HPCL, accepts that it has to pay on due date. So when the buyer has to accept this, they have to first of all agree to participate in the platform. So they give the platform the right to debit their account. It's like a check. So it's under a NASH agreement. So on the due date, nobody has to do anything. The platform will go debit the buyer's account and straight away it will pay. Who will it pay? If nobody has purchased the invoice, it will pay the seller, the small and medium enterprise. So merely by coming on TReDS, the certainty of payment has now suddenly increased quite a lot. So what this does is the Reserve Bank has said that if any bank or NBFC participates on TReDS, then it can get priority sector status because the underlying guys, only the small and medium enterprises are allowed to come on TReDS. So they say, okay, this money is all going to small and medium enterprises. It's all priority sector. As a result, the banks bid for that invoice. The bid rates can be very aggressive. To give you a perspective, for Indian Oil or HPCL or for Tata Motors, the discount rate will be as low as 5.5% if the invoice is 30 days. Usually, this is how the platform started. When it started, only AA and AAA rated receivables were being discounted. But as people got familiar with the system, more than 50 banks are now today participating. Quite a few NBFCs, starting with Geo Credit and Aditya Birla Finance, and of course my own firm, AP Factors. All of us participate on the exchange. Why do we participate on the exchange? It's a public platform. If somebody defaults on TReDS, he effectively gets thrown out of the entire Indian banking system. So you see the effect it has. A person who's rated triple B will hesitate and think 10 times before he allows a default to happen on the TReDS platform. So this is one of the reasons why historically we did a survey recently for the World Bank where we looked at the track record of triple B plus rated buyers. That is, these buyers are not triple A guys. These are all small guys who are like 1,000 crore turnover. They have a triple B plus credit rating. there were only 5 defaults in the last 5 years. That is because the public is watching what is happening. Every bank is seeing who are the defaulters on trades. The moment they are defaulters on trades, they become defaulters across the entire banking system. Their working capital gets frozen. They don't get to draw any new limits. So people are very careful. They keep their limits clean on trades. So even people who want to do bilateral deals see some merit in putting their deals on trades. They will set up the limits on trades and route the entire transaction through trades. Now,
So,
this is,
Arvind, just
yes.
sorry to interrupt. So, can I say that then a triple B plus buyer, where the invoice is being discounted on trades, is
Hmm.
a safer bet than
Yes.
investing in an NBFC or a lender or a direct buyer who's borrowing with a triple B plus rating,
Yes,
given the track
absolutely.
record that you have said, which is
Yes,
five defaults out of in 5 years, right?
yes, yes. It is literally amazing. I mean, and we have been having those conversations with rating agencies as well, and with the World Bank as well, because we wanted to do a program, which is what the budget talked about. Uh, and yes, you're absolutely right. It is not safer, it is vastly safer.
Mhm. That's a very interesting argument for an investor to start looking at securitization through TReDS, right?
Yes, yes. It is an excellent argument. And this year's budget has gone quite a way in trying to mainstream the TReDS participation from the secondary market. Where this is coming from is that the TReDS basically is open only to NBFC factors and banks. Now, there are 50 banks, most of them are already on board. There are 5 trading platforms. There's not just one. There's one which is essentially sponsored by SIBI, that is Receivable Exchange of India, RXI. It's the largest. But right alongside it is M1 Exchange, is Axis Bank sponsored A-Trades, and there are two more, TReDS and C2FO's platforms. All these guys are looking for volumes. But each of them is trying to increase the appetite for triple B plus type assets, because that's where 50% of the rated companies in India are. Now, how do you increase the appetite? The increase the appetite by getting more participation. How do you get more participation? There are only so many banks. But if a bank can find a model where whatever it's originating on trades, it will keep a skin in the game of 5% or 10% and sell the rest of it to the secondary market, then there is a lot more liquidity which can come in. The idea is you create a pool of maybe 100 triple B plus assets. Because of the history of collections, this pool of 100 triple B assets as a pool will behave in a certain way. If you provide a 10% credit enhancement as a first loss guarantee, the remaining 90% is likely to achieve a rating of double A plus or double or even triple A.
Mm-hmm.
And with that kind of a thing, it will attract mutual funds. It can attract retail investors because the securitized instruments are open to everybody.
Mm-hmm.
It is not only banks and NBFCs who can participate. And this is where the RBI's ambition that it wants to go from this current 3 4 lakh crores growing at 25%, 30% per annum to 30 lakh crores, to 1 lakh, to 100 lakh crores is the ambition. Why 100 lakh crores? In FY25, CRISIL said that the MSME credit gap is 100 lakh crores.
Mm-hmm.
That tells you that, when people talk about India becoming global superpower and all that, it is this sector which is really struggling for capital. And the instruments and the infrastructure that we provide to help get the finance reach them, to get the penetration down, is important. And TReDS is one of those which has probably succeeded better than most other initiatives.
Absolutely. Uh, Arvind, as I was telling our listeners at the beginning of the podcast, that you are doing a phenomenal job in enabling this more working capital finance to reach the SME and MSME sector. Could you just take us through how your platform works and how you safeguard risk for your company as well? And
Yeah,
what all could be the risks that are there and how that is getting mitigated through
sure.
the system that's being
Yeah,
followed here.
yeah. Thanks, Arjun. So it's a plug for my product as well. So what we are is a profit-making non-bank finance company structured as a factoring company. The idea of having a factoring company was that under law, we have recourse to the buyer as well as to the seller. On the TReDS platform, only non-recourse financing is allowed. That is, the MSME is not held responsible. It is the payment obligation of the buyer. But small obligors, small buyers, are actually indifferent about whether it is with recourse or without recourse. They do not expect to vanish. They say, no, no, if there is a problem, I'm still there to hold your hand and I will do the thing. The challenge is that they are small, so you can't put your bet on them. What we do in our platform is we typically say, okay, you've given money to, you've supplied goods or services to a large company. So, for example, we have a client in Bangalore who does the back end payables financing, payables reconciliation for IBM. So every month he will bill IBM and IBM will show on its portal that this is the amount you have billed, this is the invoice, and this is the payable. Over the last 8 years, he has had no defaults because IBM needs that every month recon to happen. So what we do is we take his login credentials and we look at his IBM portal to see that, okay, this is the amount that is due, and we pay it. Separately, he has sent a notice to IBM saying that, look, any money that is due to me should be paid into the special account, which is controlled by AP Factors. So AP Factors will receive the money from IBM as and when it gets paid. Typically, IBM pays after 120 days. It tells you the scope of the problem for the MSN. This is
Right.
like, so he's got to wait 120 days, but in the meanwhile, he has to pay his employees. He can't say, no, no, this month I can't pay you or something like that. So there's a significant amount of his equity which is normally getting trapped in this. So what we can do is we do one of two programs. We either do a with recourse or a without recourse program. Usually the client is indifferent to it. So we say, okay, if you're indifferent, you might as well do it as with recourse so that if there is ever any problem, then I will come back to you. But the two key elements for us, trapping the cash flows from IBM and ensuring that it comes into the escrow account. Second, before discounting, we check on the IBM portal that it is actually acknowledged and the amount is mentioned. Once we do this, we have an asset on our balance sheet. What we do is we pool these receivables from names like IBM, JLL, Amazon, Flipkart, L&T, all these guys, anything above A minus, we create a pool, we put it into a special purpose trust and issue a note. This is the crux of securitization. So when we do this securitization, all these assets form the underlying assets and against which we are issuing the securitized note. It's called a pass-through certificate. It can be rated and it's listed as well. Our last rating was A minus from ICRA for a pool where 70% of the pool was AA or AAA buyers, 30% was A minus. So once we put that together, what happens is investors come in for whatever amount that they want to subscribe, which could be 5 lakhs, 10 lakhs, whatever is the amount. And from our perspective, we have a skin in the game. The first 10% of the loss is ours. Plus, we give a 5% fixed deposit to the Access trustee, who's the trustee who's running this whole process. All flows which come into the escrow have to be transferred within 1 day to Access trustee, who then apportions the money. So some of the money will go to the trust for retiring the receivables which are due on that particular day. Some of the money will come back to us for assets which are held by us. And some will go back to the client because typically when we discount an invoice, we discount 75% of the value of the invoice. So this is
Right.
broadly what we do. We currently have experience, we've discounted something like 700 crores in the last 2 years. So far, we've had no defaults, largely because of the process where we are able to check with the buyer's portal and confirm that the payment is due.
In one way, also the GST system
Yeah.
is a huge, huge benefit for you to assess the credit quality
Yes.
of supplier as well, isn't it?
Yes, excellent point. I forgot to mention that. So when a client comes to us, he has paid GST on it. And thanks to GST today, there is a GST network where we are able to get the data with the client's consent. So the client can give us access to the GST data that he has submitted to the government. What this shows us is how much has he supplied to that particular buyer. So if he comes to me and says, okay, I have supplied 5 crores worth of services to IBM, that will show in the GST portal that, yeah,
Correct.
this is the track record. He has supplied over the last so many years, how much to IBM. The second thing is the GST network also shows me something called credit notes. So let's say IBM got billed for 5 crores, but only paid 4.9 crores. So they will give him a 10 lakh credit note. And that number also comes back from the GST network. So I have a very good idea as to what was the short payment or the credit note. So, is he collecting 90%? Is he collecting 95%, etc.?
Right. So that's a very strong validation point as well. And here, clearly, I mean, if I'm looking at a credit risk perspective, I'm looking at all the buyers, not the sellers,
That's right.
right? In terms of, okay,
Absolutely right.
so we'll have a pool of buyers. I mean, there's some, like you said, 70% could be AAA, which could be Amazon, Flipkart, and others of the world. And then you have the double A and A plus and even triple B plus kind of buyers, right?
Yes. Yes.
And then the rating agencies, take consider the whole mix of the buyers, and
Yes.
then they rate it based on the stability of the buyers. Would that be right?
Absolutely right. So they look at
Perfect.
our past track record. For the triple B plus assets, we have gone back and taken insurance from SBI Insurance. More as a policy decision. We have not had any occasion to claim from SBI, but it gives investors some comfort that yes, it's triple B plus, but an insurer such as SBI, which has been in business for the last 30 years, has had a view on it and will pay if the buyer goes insolvent. As you said, the whole risk is predicated on the buyer, and the buyer is a much larger entity with greater financial strength. It is not an MSME payment obligation, it's a buyer payment obligation. And the rating agency takes that into account. That's why typically what they do is they set us concentration limits, saying per buyer you cannot be more than 5% or 10%. Per rating, if it is, A minus, you cannot go more than 25% of the pool. Things like that they come up with. Per invoice, you cannot be more than 3% of the pool. So some of these conditions are quite detailed, and we've built all of that into our platform because you have to do it real time. You can't post facto correct it. At the time you are doing the discounting and creating the pool, and as it changes, you have to keep monitoring it. We do all that.
Right. And in terms of PTCs itself, SEBI has come out and said that the minimum lot should be 1 crore in terms of, so that the reason they have come out is that they want to make sure the investors know what they are investing in when they're investing through a securitized pool. So even though the finance minister has come and clearly spelled out that the securitization is a very valid and regulated transaction, still I think SEBI is very clear on the investor side that okay, if those who can invest 1 crore into one BTC, then they would know enough to invest in that particular PTC. Where I'm coming from is that in this kind of there's a huge demand for wealth in terms of the new products, etc. What and in terms of a risk return perspective and in terms of maturity. So in a securitized transaction where you can securitize your receivable, the receivables that you have given, that you have discounted, what would be the tenor? I mean, what would be the average tenor, and what could be the lowest and the highest, and what would be the sweet spot for both the issuer and the investor?
Yeah, a great question, really. So, as you would expect, working capital limits are typically anything from 15 days to as long as, say, 180 days. So, IBM is like 120, 130 days sometimes. The Amazon stuff gets done in 15 days. And in fact, they pay in parts. Though, so they pay 7 days, may they pay 25%. Then they have a return policy, so they keep back 75% for about 20 days. And then they finally, by the time everything is released, nearly 30 days has happened. On average, it's 15 days. In our portfolio, typically the average tenor is about 55 days. And what it does when we do the securitization, it does not make sense to do an invoice to invoice securitization because there are payments which are coming up every day. Clients want to discount invoices as and when they raise the invoices, which is almost a daily task. So
Correct.
somebody will want 20 lakhs today, somebody will want 25 lakhs tomorrow. And that is like, but one invoice could be as low as 15,000 rupees. So there is no restriction on that front. What we do is we say, okay, let's do a 6 month instrument. And on day zero, there is 10 crores worth of assets in that. A week later, maybe about 50 lakhs has got repaid. So as and when every day, whatever repayments happen, it goes to the trust. The trust is sitting on repaid invoices. That means at the end of a week, it's got 9.5 crores of invoices and it's got 50 lakhs worth of cash. So we give it new invoices from the same approved names, which have followed the same standards. And the trust then purchases those new invoices and releases the 50 lakhs. So we do this on a daily basis so
Daily
that
basis.
yeah, so our replenishment works on a daily basis. And it takes the system has to actually be evolved the system over 3 years to manage this on a daily basis. Every day there are cash flows back and forth. At
Mm.
the end of a month, the rating agency requires a chartered accountant to certify that all the conditions that it uh, imposed have been followed. So that also happens. So the trustee will say, okay, where is your CS certificate? So it will say, okay, have I transferred all the monies within 24 hours? Was the rating parameters about the concentration met? All of those. So SEBI also has started asking for quarterly reports. And RBI also has a policy of asking for quarterly reports where we have to report what was securitized, what was the level of delays, what was the concentration, what is the weighted
Mm.
average yield. So it is a fairly regulated product now with a lot of reporting both to SEBI and as an NBFC, we are required to report to RBI.
Right. So the tenor can be vary from anything from 6 months, 1 year, 1.5 years, I would guess, because it's a daily replenishment of your of the
Correct.
receivables and the
Yes.
underlying. And
Yes.
in one sense, the fact that the money keeps coming in, right, that itself is a
Yeah.
very strong risk avoidance factor for investors as well, because the the money, it's like a coupon payment, right? But it's not a coupon payment, right? So the money just
Yes.
keeps coming in and then it gets replenished out. Would that be
Correct.
right?
Yes, absolutely right. And also the other condition that the SEBI, that the rating agency imposes is, let's say that for some reason one of the buyer payments is delayed. If it goes past 30 days, then that guy is kicked out of the program. He's not going to be coming back again. So let's say it got paid in 35 days, then he is not there in the program anymore for the next
Right.
6 months.
Hmm.
So, why this happens is that sometimes you have to, there is a problem between the two companies. It doesn't all come to a default on day zero. It basically simmers and festers. And the way it reflects is that there are delays in payments because the invoice number may not be correct. Or
Hmm.
he has, done something and then he has said, okay, your past payment, there was some problem, so I'm not releasing this payment today. Eventually, it will get released. But the delay pops up as an early warning. So in our case, very rarely do we see any delays beyond 15 days. The 15 days is because sometimes there are holidays, there are some payment delays, etc. So very rarely we see anything going beyond 15 days. And that's how the history has behaved so far.
Right. And is there you have the facility to replace a buyer as well in that pool, right? Or
Yes,
you
yes.
have
So
to.
we take an approval for some 30 odd buyers or 40 odd buyers.
Okay.
So so that's the pattern.
Right. And so in this, like you were saying, right, Arvind, on the threads itself, it's very, in terms of it's all PSUs and others. So the rates are very low in terms of, it's like a money market instrument, like closer to 5 quarter, 5.5, in terms
Yeah.
of that's where the overnight money is trading, right? So
Yes.
it's just one more avenue for banks and others to park their money, right?
Yeah.
Uh, Now, when it comes to platforms like yours,
Yeah.
and where the clearly there is a difference in the sense that the buyers could be across, right?
Yes.
It's not only AAA, but it could be others as well,
Yes.
and then obviously suppliers to them, right?
Yeah. Yeah.
So clearly, I think in this sense, the returns one can expect from securitized receivables from
Yeah.
platforms like yours should be much higher than what the trades platforms themselves normally offer, right?
Yes. It's a good point. So trades typically, when you look at the triple A, double A type assets like Indian Oil, Tata Motors, those are discounted at 5.5%. And that's like, close to the repo rate. If you are rated A, you might get to some 7.5 or so. And if you're triple B, it gets to 9.5 or 10. So why doesn't everybody go on TReDS and discount? It's the most attractive platform. The challenge is that, first of all, the buyers have to cooperate. The buyers have to formally come and sign up with the TReDS, give them the debit mandate, and put all these guys and accept these invoices at everyday level. And that is something which many people are very reluctant to do. To give you a typical example, why would a client who's supplying HPCL and who has limits on trades come to me? HPCL will accept his invoice on the 40th day. So, as an MSME, he's entitled to get payment by the 45th day. When 5 days are left, he will accept it on trades. This is already reflecting on HPCL's buyer portal. So he has already accepted the goods. There is nothing which is a problem. But he's a little lazy and he'll come on TReDS on the 40th day and accept. So on the 40th day, he will get 5% invoice discounting charge for 5 days. But what about 0 to 40? So that's where we come in and we say,
Right.
okay, look, it's unsecured. I've seen it on your portal. I'll discount it. And we were doing this for a company who was providing all the manpower for all the Bharat Petroleum pumps across India. BPCL would pay him on the 42nd day or the 43rd day from payments on trades. Until then, he was drawing funds from us at 15%. Why 15%? The unsecured business loan market is the only other alternative way for him to raise money, and that is at 15 to 20%, because nobody is really looking at the buyer risk. They're looking at him as an MSME. They don't care that this is an invoice from Bharat Petroleum, it's showing on the portal, and so on and so forth. Because we earn 15%, we can pay a coupon of 11% on the PTC. So that's how our math works. To a certain extent, the risks we are taking are, there is an ALM risk. My asset matures in 15 days, and I'm taking the call that it is going to be redeployed. So I had to make some adequate margin to ensure that on the days on which we do not have an asset and the asset is not earning anything, the rest of the payments from the high coupons on the higher assets is making up for it. So quite frequently we buy assets for 3 days, 5 days on TReDS
Right.
at 5.5% yield to
Mm.
manage maturities. So that's one of the reasons why there is a significant gap between the rate at which we charge our clients and the rate at which we pay investors.
Right. Got it. So the smart money here is that, for an HPCL invoice and a BPCL invoice who's like lazy, the
Yes,
smart investor here is like making the most of it, right?
yes,
Yeah, and I think that's a very strong signal to wealth managers and investors who understand what they're doing in investing about looking to participate in such your PTCs or similar such securitized notes where the end buyer is the best in the country in terms of
yeah,
credit rating,
yeah,
but because of some operational issues, you get a much higher rate where and in a shorter period of time, where
yeah,
normally you would never be able to lend to, say, an HPCL or a seller to an HPCL at these levels, right?
yes,
So clearly, I think there's a huge amount of traction that can happen. INR Bonds as a platform itself is committed to providing very strong risk return solutions to investors. Obviously, we only deal in listed and rated instruments. And as your PTCs are listed and rated, and also because of the fact that SEBI is very clear that it should be the transaction size should be minimum 1 crore, purely because they want to make sure that those who invest in such securitized papers understand what they're doing. And our bonds is very, very clear in that sense as well, in terms of what investors should understand, what they should know about these papers, etc., before they want to even look at investments. Um, Apart from that, how do you see this going forward, Arvind? I mean, in terms of this, for example, the direct lenders are there's a huge amount of interest in direct lending. For example, there are a lot of lenders that are coming up who either lend secured, unsecured loans to SME and MSMEs, and they are growing their balance sheets and very largely providing working capital. Now, can platforms like yours, in terms of providing working capital, can they also replace some of the or be a very large part of this ecosystem as well in the MSME SME lending space?
Yes, so it's a good thing you brought up. So internationally, factoring is a extremely well known and well regarded product. Unfortunately, in India, there were many issues with the way the RBI stipulated regulations. And the crux of the RBI's fear was that there is no way to actually verify that these are genuine transactions. The fear in RBI's mind is that these are all accommodation bills. That is, I drew a bill. Hundi has a historical connotation. It goes back to hundreds of years. So
Right.
in the market, you discount a hundi, it's a note of hand and it is a legal tender,
Mm.
but it may have no underlying goods or services behind it. With the GST, that has changed. So
Mm.
since 2018-19, when the GST data has been available, it is possible for you to map the invoice number to the GST portal to say that actually there has been some tax paid on it. It's unlikely that somebody paid a tax, even if it is 2% or 3%,
Right.
on a fictitious
Mhm.
transaction. It's just not worth it, you know. So now the authentication has become a lot better. So one fallout has been that a lot of big institutions like Tata Capital and Geo and all of them have taken a factoring license and they have started doing it and they've put it on their balance sheet.
Mm.
However, they're coming from a lending mindset. So what happens is, because they are not looking at cash flows, they're just looking at the basic financials, and unless the buyer accepts formally, they will not do the discounting. Where we come in is, we know that the buyer has accepted on the portal. That is legal evidence. So our advisors for this transaction was Amarchand Mangaldas, and we've taken tax opinions from KPMG. So some of the portal screenshots are legal evidence. When we go with that to the client, to Amazon, for example, in a couple of cases where there were delays, we could point out that, look, you accepted on the portal. Is there a problem? And then they've said, no, no, this is an operational issue, and they sorted it out. So some of that experience is only slowly now coming into the mainstream. As it happens, many of the factoring companies will grow disproportionately and take on a significant chunk of the working capital financing burden. We do see this exploding. Like right now, the biggest factoring company has about 5,000 crores of assets. In 5 years' time, this will be like approximately, 2 lakh crores or 3 lakh crores.
That's
That's
a very
where it.
strong. Mm. Yeah, that's a very strong growth. And yeah, I mean, as a platform, INR Bonds understands the whole business of what you are doing, and especially the impact that it's creating in the SME and MSME space, where I mean, 65% of India's GDP comes from this, or even more, right? So
Yes.
it is the most important space in the country, and government realizes, central bank realizes, the capital market regulator realizes this, and it's up to us to educate investors to make sure that they understand the product, and then they are able to finance a part of this growth, right? Yes. So we will be. I mean, this podcast was the. And thanks for coming on to the podcast, because it's something our investors and the listeners, especially after the union budget, where the finance minister mentioned TReDS, and I'm sure many of them would not have been aware of TReDS as well. What is TReDS, etc. Now, I'm sure they have a very deep understanding, and they would definitely want to participate in this in terms of an investment point of view as well. Um, and we would be definitely there to educate them and then list some of the securitized assets for larger clients onto the platforms and take this forward. Yeah, just before we close, to highlight the risks in all these bonds and securitized instruments, is they carry credit risk where there's risk of default, interest rate risk where rates can go down and up and prices can go down and up, and liquidity risk where the cost of buying and selling can be pretty high. So investors should understand these risks before investing in any of these investments. But thanks, Arvind, and thanks a lot for explaining to our listeners the whole concept of TReDS. And look forward to having you more on the podcast.
Thanks, Arjun. It was great talking to you.